L1 Capital is a global investment manager founded by myself and Rafi Lamb in 2007. We have offices in Melbourne, New York and London, and we manage around $3 billion for institutional clients, high net worth and now retail investors. Institutions like large superannuation funds, endowment funds, global private banks, insurance companies, and in the last few years we've opened up our funds to high net worth investors and more recently retail. Historically we've been managing money for institutions and high net worth investors, and we believe that a long short fund has delivered fantastic returns to those investors, and we thought it would be a great opportunity to open the fund up to retail investors. The fund is able to do a lot more things than a typical long only fund just by its nature, and we think that provides much better risk management and also much better opportunity set, which retail investors don't necessarily get access to normally. We're very aligned with our investors. We're making a very large investment in the listed investment company on day one, and we're locking that up for 10 years. We're also reinvesting all performance fees back into the LIC and locking that up for 10 years as well. So people should realise we're very committed to the listed investment company long term, and we're going to be very aligned with our investors. The investment objective of the LIC is to deliver strong, positive, risk-adjusted returns with significantly less market risk than the ASX 200. Our investment philosophy is that we're trying to find the best possible company at the best possible price. And essentially we're trying to balance value and quality in the way that we find great companies. We're bottom-up stock pickers, and we find that the best way to understand companies and industries is to do really detailed bottom-up research and then to build small positions across the portfolio. We're really trying to find companies that have really strong management teams, great industry structures and favourable operating trends, and also have valuations that are compelling based on cash flows, not based on accounting profits. Accounting profits can be manipulated, whereas cash flows are much harder to adjust. So what we're trying to do is to find a portfolio of longs that we're buying. Those stocks are ones that have favourable attributes, and to short stocks or bet on those shares falling based on companies that have worse attributes. And essentially the difference in the performance of our longs and shorts will generate returns for our investors. All the key risks are outlined in detail in the prospectus, but from our point of view, the main risk is shorting. Shorting is a distinct skill set that not that many fund managers have proven an ability to add value in. We manage shorting risk by reducing position sizes, having smaller position sizes for shorts versus longs. We insist on a catalyst, and we have a very disciplined process around managing position sizes and closing out short positions. We also believe that shorting provides really good downside protection in a falling market. If you're in a long-only fund that doesn't do shorting, you're exposed to market falls far more dramatically than if you do shorting. We use short selling primarily to generate profits. We love the ability to be able to make money from share price falling, not just from share price going up. But one of the benefits of doing shorting is that it lowers your overall market exposure, and it gives you much better downside protection in a market sell-off. The portfolio tends to average around 80 positions. Roughly 2/3 long, 1/3 short. We are primarily Australian focused, but we have around a quarter of the portfolio that tends to be international with a hard limit of 30%. We also tend to do small position sizes. So we might have 2 or 3% of the fund in one particular stock. We don't tend to have 10 or 20% of the fund in an individual position. And the reason for that is we want to take the view that we'll get more things right than wrong, but we're not sure which positions that's going to be, and we'd much rather be very diversified by stock and sector, which reduces overall portfolio risk. The main reasons to invest in the L1 LIC is that the strategy has a proven track record of performing both in rising markets and falling markets. And secondly, the team is extremely aligned with our investors. We have a lot of our own money in the fund. We'll be investing a lot of money in the IPO for the LIC, and we're also reinvesting all the performance fees back into the LIC with a 10-year lockup, which proves our long-term commitment and optimism about the product.